In 2024, the richest 10% of Americans owned nearly 90% of all stock market wealth. But here's what almost nobody tells you. The stock market wasn't built for them. It was built for you. And right now, most people have no idea how it actually works. What are you actually buying when you buy a stock? A piece of paper? A promise? A company? Why does the stock market go up for decades and then crash overnight? Why do some people call it investing and others call it gambling? Who's actually right? And why does your retirement, your parents' retirement, basically the entire US economy, depend on this thing you were never taught in school? By the end of this video, you'll know the answer to all four. Here's the part nobody says out loud. If you have a 401k, if you have a pension, if you've ever even heard the phrase compound interest, the stock market is already controlling a piece of your future, whether you understand it or not. Social Security was never designed to fully fund anyone's retirement on its own. Most financial planning assumes people fill that gap themselves, usually through investing. So this isn't trivia. This isn't a nice to know. Right now, today, money is being made and lost by two kinds of people who understand this system and people who don't. This video is about moving you into the first group. Let's start with the most basic question of all. One most people can't actually answer. Let's go back 400 years. In 1602, a company wanted to send ships to Asia to trade spices. The problem? A single ocean voyage was wildly expensive, and if the ship sank, the person who paid for it lost everything. So they came up with an idea. Instead of one person funding the whole voyage, thousands of regular people could each put in a small amount of money. In exchange, each person would own a tiny slice of the company, and a tiny slice of whatever it made. That company was the Dutch East India Company, and that idea, selling small pieces of ownership to regular people, was the birth of the stock. Here's a simpler way to picture it happening today. Imagine your friend runs a lemonade stand, and it's doing incredibly well. She wants to buy a bigger cart, but it costs $1,000 she doesn't have. Instead of borrowing the money, she makes you an offer. Give me $10, and you now own 1% of my lemonade stand, forever, including 1% of every dollar of profit, for as long as the stand exists. That's a stock. When you buy one share of a company like Coca-Cola, you technically own a microscopic sliver of every bottle sold, every factory running, every dollar of profit made, today and every day after. So a stock isn't a piece of paper. It's not a lottery ticket. It's ownership. But here's the question that trips almost everyone up. If a stock is just ownership, something that doesn't change much day to day, then why does the price on your phone jump around every single second the market is open? Ownership doesn't move that fast. Or does it? Here's the twist. The price of a stock has almost nothing to do with whether the company is good or bad today. It has to do with something much stranger. A live auction, running for 6.5 hours a day, every single weekday, with millions of buyers and sellers all shouting price offers at the same time. Picture a used car at an auction. The car itself doesn't change. But if 10 people show up wanting it, the price shoots up. If nobody wants it that day, the price crashes. Even though it's the exact same car, running exactly as well as it did yesterday. Stocks work the same way. Except the car is a piece of a company, and everyone bidding on it is really betting on the company's future, not just how it's doing right now. That's why a company can announce record profits, its best quarter ever, and the stock still drops. It sounds backwards, but it isn't. Investors had expected even more. So even great news becomes a disappointment. And people sell. So prices aren't random. They're psychology, running at scale, in real time. Which raises the next obvious question. If the price is just a constantly shifting guess about the future, how does anyone actually make money doing this? Is it luck? Is it skill? Or something else entirely? That question is exactly why two completely different games exist inside this one market. And confusing them is what quietly ruins people financially. Wall Street lets you believe these are the same activity. They are not, and mixing them up is one of the most common ways people lose money they can't afford to lose. Meet two people. Dave puts money into a broad, diversified fund every month and doesn't touch it for 30 years. His graph is boring, flattish, unremarkable, until you zoom out. Jason, on the other hand, buys and sells based on whatever's trending online this week. His graph looks like a heart monitor. Thrilling highs, sickening drops. Investing is like planting a fruit tree. You put it in the ground, you wait, sometimes for years, and it slowly, quietly grows. It's boring, but it's reliable. Trading is like trying to guess tomorrow's weather, so you can sell umbrellas at exactly the right hour. It can be exciting. It can even work, sometimes. But it's much closer to a coin flip than a plan. It's well documented that most professional day traders, people who do this full-time, with real training, lose money over time. Meanwhile, people who simply stayed invested in broad markets across multiple decades have historically seen their money grow. So if long-term investing is the boring but reliable path, why do we keep hearing about markets crashing 30, 40, even 50% in a matter of months? Doesn't that wreck everything? To answer that, we need to talk about the single most misunderstood event in financial history, the crash. In 2008, people watched their retirement accounts lose almost half their value in a matter of months. Some panicked and sold everything they had. Others didn't touch a thing. Only one of those groups fully recovered, and it's probably not who you'd assume. The people who sold during the panic locked in their losses forever. The people who did nothing, who just waited, eventually watched their accounts not only recover, but grow far beyond where they started. Here's a way to picture it. Imagine your house's estimated value drops on paper during a rough year for housing. Have you actually lost money? Not unless you're forced to sell at that exact moment. If you just keep living in it, that paper drop doesn't touch your real life at all. Stocks work the same way. A crash only becomes a real loss the moment you sell during it. Historically, every major U.S. market crash, 1929, 1987, 2000, 2008, 2020, has eventually been followed by a recovery to new highs. That's not a guarantee about the future, but it's the honest track record of the past. So if crashes tend to recover, why does almost everyone you know say the stock market is too risky? Is that fear actually justified, or is something else going on entirely? That fear comes from a myth, and we're about to tear it apart completely. Let's say it plainly, because you've probably heard it 100 times. The stock market is just a casino for rich people. Here's the twist most people never hear. The stock market is actually one of the very few wealth-building tools specifically designed to be accessible to regular people, through retirement accounts, low-cost index funds, and today, even fractional shares that let you buy a piece of an expensive stock for a few dollars. And here's the part that reframes everything. Avoiding the market entirely, out of fear, is often the riskier long-term choice, because cash sitting still quietly loses purchasing power every single year to inflation. The people who call this a rich person's game are usually the ones standing outside of it. And staying outside of it is exactly what keeps the wealth gap growing. This isn't about becoming a stock-picking genius. It's about understanding the simplest, most accessible tool inside this entire system, the one almost nobody advertises loudly enough. There's a strategy so simple that most highly paid Wall Street professionals secretly can't beat it over time, and you can start using it with less money than a dinner out. Remember the lemonade stand? Now imagine, instead of betting everything on one stand, you owned a tiny slice of 500 different lemonade stands across the entire country, all at once. If a few of them fail, and some will, it barely matters, because most of them keep growing. That's essentially what an index fund is, a single investment that owns small pieces of hundreds, sometimes thousands of companies at the same time, instantly spreading out your risk. The S&P 500, which you've probably heard mentioned on the news, is simply a collection of roughly 500 of the largest companies in the United States, bundled together. Buying into a fund that tracks it means you own a sliver of all of them at once, instantly diversified, without picking a single winner yourself. This approach is famously championed by some of the most successful, most respected investors alive. Not as a shortcut for beginners, but as the smartest option for almost everyone. So here's the obvious question. If this is genuinely this simple, Why doesn't everyone just do it? The answer isn't math, it's psychology. And it's the real reason most people fail at investing, even when they know exactly what they should be doing. Here's an uncomfortable truth. The stock market doesn't ruin most people's finances. Their own brain does. There's a pattern that plays out over and over, in almost every generation. People get excited and buy in when prices are already high and everyone's talking about it. Then, the moment prices fall and the headlines turn scary, those same people panic and sell. At the exact worst time. Picture grocery shopping in reverse. Imagine sprinting to the store to buy milk the second the price doubles, because everyone else is buying it too, and then dumping all of it down the drain the moment the price drops back down. It sounds absurd with milk. But that's essentially what panic selling during a market downturn looks like. It's well documented that, on average, individual investors tend to underperform the very funds they invest in, not because the funds perform badly, but because of poorly timed buying and selling driven by emotion. So if the real risk here is emotional, not mathematical, what does it actually look like to invest the right way, long-term, without losing your mind every time the market dips? Let's put every piece of this together, because this is where it all finally clicks. There is no secret formula hiding here. The entire system of stock market wealth building comes down to 4 things, and none of them require being a genius: ownership, time, consistency, and emotional discipline. Picture a snowball rolling down a hill. At the top, it's tiny. It barely seems to be moving. But the longer it rolls, the bigger it gets. And the bigger it gets, the faster it grows. Near the bottom of the hill, it's massive and almost unstoppable. The hill, in this case, is time. Here's a purely illustrative example, not a promise of what will happen to anyone. Someone who consistently invests a modest amount every single month into a diversified fund and simply leaves it alone for several decades can see that money compound, meaning the growth itself starts generating more growth, into something dramatically larger than what they put in. That's not magic. That's math, given enough time to work. But there's one more twist most people never see coming. Something that changes how you should think about all of this, starting today. Every dollar you keep in cash is quietly losing value while you sleep. The stock market isn't a luxury for people who like finance. It's closer to a defense mechanism. Cash sitting in a jar loses buying power every single year. Slowly, quietly, like ice melting in a warm room. Investing is how people have historically tried to stop that melting, by putting the money to work instead of leaving it out in the sun. The same amount of cash saved decades ago buys noticeably less today. That's not a controversial claim, it's simply what inflation does, year after year, whether we notice it or not. So now you understand what the stock market actually is: a system of real ownership. A live auction driven by expectations. A place where crashes are usually temporary and panic is usually the real damage. A place where the simplest tool, the index fund, quietly outperforms most of the complicated ones. And a place where time, more than intelligence, is the real engine of wealth. Here's the idea that ties everything in this video together. The stock market isn't gambling, and it isn't magic. It's simply a system that lets regular people own tiny pieces of the world's most successful companies. And the biggest factor in whether it works for you was never intelligence, and it was never luck. It's time, and it's temperament. We didn't start this video to make you an expert. We started it to remove the confusion. The kind that keeps smart, capable people standing on the sidelines of a system that was built, in part, for them. A stock is not a mystery, it's ownership. A crash is not the end, it's usually just a pause. And the biggest risk in all of this was never really the market. It was ever letting fear make your decisions for you. You don't need to predict the next crash. You don't need to pick the next big winner. You just need to understand what you now understand and give it time to work. That's the whole secret. There was never a secret at all.